Good morning and welcome once again to Digital Look TV in London. Joining us today is Simon Edelsten. He is the fund manager for the Artemis Global Select fund. Simon, good morning. Thank you very much for joining us. Okay, investors are probably a bit scared. We've had quite a ruckus in the markets with, I wouldn't call it a blow up in emerging markets, but certainly a lot of stress. How do you evaluate the situation?
Well, I think the situation with equity markets over the last 3 years has been a series of scares about various different parts of the world. But there's so much money been printed by central banks that each of these scares gets sorted out fairly quickly. So, but there's always a reason. If you look around the world, there's always a reason not to buy equities. There's always a reason to leave your money in the bank. The question is, trying to keep those issues into perspective. So, last year it was sovereign risk and the Greek crisis. In the spring it was Cyprus. Now it's emerging markets. But it's worth reflecting how quickly markets get over these things. At the beginning of the year, people were saying in the middle of the year, people were saying China was going to be a disaster.
Indeed, yes.
A couple of months later, India's got problems, but China doesn't seem to have problems. China is still chugging along with 7% and a bit growth. That's hardly a disaster. And actually, the stock market's been very, very strong the last month and a half. The papers don't mention that. They mention the disaster they foresee before.
You were telling me earlier, emerging markets in May, they didn't seem at all fazed by what was going on globally. And now all of a sudden, this scare. What changed, if anything?
Yeah, I mean, it's quite specific. As you say, when the tapering in QE was first announced in May, emerging markets were quite stable. Even when China put interest rates up to try to calm down its housing bubble, which is a little later than that, they pretty much sailed through that. People worried about China. Okay. But the markets that have been hit hard, or the currencies that have been hit hard in the last month, have really just been India, Indonesia, and Brazil.
And why?
And each of those countries have very large need to import oil.
I see.
In each case, the government's promised cheap diesel for farmers, and if they take those subsidies away, then they don't get votes. They don't get voted in. There's a big Indian election next year. They've tried to reduce. They have been reducing the cost of that fuel subsidy, but it's such a big political issue that it's very difficult for them to, and that's why their currency quite often gets hit. Got hit very badly back in '91. The good thing, the less worrying thing about India having a crisis is it's quite a closed economy. It's not like China, which really affects the rest of the world, or America, which is half the world.
I see.
India can have problems without it necessarily derailing global growth.
Okay. You see an opportunity in emerging markets at the moment?
Well, we've stuck with China. China is a market which we regarded as part emerged. I mean, it's quite a mature economy. Chinese quite wealthy. We had a lot of money in Southeast Asia, Philippines, Thailand. Fortunately, we took a lot of profits there in the spring.
All right.
But that was really just because the shares had already shot up an awful long way, and it struck us as better value for money to sell the consumer stocks out there, which have become very fashionable, very popular with a lot of emerging market and global fund managers.
How popular? You're telling me before something about their EPS.
Yeah, I mean, the ratings on some of these stocks have really become very stretched. So a company like Nestle Nigeria, which is a very fashionable stock amongst frontier investors, I think on Bloomberg numbers anyway, that's on about 35, 36 times earnings. The parent company that controls it in Switzerland's on about 16, 17 times earnings. Now, one of them is a lot safer than the other. I'm a natural coward. I prefer to protect people's capital in these very turbulent markets. And I want better value for money. I mean, Nestle in Switzerland yields 3.5%, 3.45%, whereas in the Nigerian company won't give you that stability either. It's better finance. So why take the risk? Enjoy a bit less growth, a bit more stability, but get better value for money for long-term investors.
Right. Protect your clients' money.
I think that's absolutely key in a market which carries on being this nervous.
Okay. Your investment style. You seem to have a rather eclectic mix. You look for long-term macroeconomic themes, sort of, and then you mix that with quite a fundamental approach when screening for stocks.
Yep.
You seem to have a preference for the enterprise value free cash flow ratio. Perhaps if you could just run us through a little bit as far as the reasoning behind your investment style? Why you prefer to go this way?
Well, absolutely, it follows hopefully from what I've just run through. If you, when you're a global equity investor, you have so many stocks to choose from that you can really define quite unusual, differentiated investment approaches and stick to them. And our approach is to try to avoid, as far as possible, trying to pick the cycle, trying to avoid having a portfolio which relies on central bankers moving interest rates the way in which you hope, or the economic cycle working out the way in which you expect, because you get it right some of the time, but you get it wrong some of the time, I'm afraid.
Right. So you don't want to depend on central banks
We want to pick stocks which have got a long-term stable following wind. So we try to find themes such as, the biggest theme we have in the portfolio at the moment is what older people in developed markets, who are all the people who've got all the wealth of the world, what they're going to spend their money on as they get older. Leisure activities, healthcare, of course, but also trying to spot consumer trends amongst the older generation rather than the younger generation. That in past cycles in developed markets, generally it's been the young people who've come out of college, set up home, had families, they've done all the spending. Unfortunately, the young people today come out of college with a load of debt, and all the money's with older people, and the pensions we try to help them try to help fund. But stocks which appeal to that generation, stocks which show consistent trend of them spending more money on, are few and far between. But we've made very good money in things like cycling companies. We own Shimano in Japan. Outdoor leisure activities. We own a hunting, shooting and fishing retailer in America. And these companies are benefiting from these stable trends. So, when tapering comes along, when the Greek crisis comes along, when India crisis comes along, it doesn't make much difference to these businesses.
Less risk and volatility?
Much more certain, but you do have to be patient. And there are going to be times when the market gets excited about growth. Markets got very excited about European growth. These stocks aren't going to be affected by that positively either. So they tend to sail through these things, and that's what we want as the core of our portfolio. The key feature of this, and this is increasingly important as the markets keep going up, is when markets get, when the cycle comes to an end and markets really start going down, these are the sorts of companies which will, relatively speaking, protect some of your capital. So this investment style does particularly well in bear markets. We haven't had a bear market for an awfully long time. So we try to keep up with a bull market like the one we've seen. But when the markets turn, in the past, this style has really worked particularly well in protecting people's capital in weaker markets. It's still an equity fund. Still going to go down with the equity markets, just go down a lot less than a lot of other investment styles.
Given the relatively large rise that we've seen globally in equity markets for the last, 12, 18, 24 months, might that be a particularly desirable characteristic when choosing a fund?
Well, our policy is to look after people's money over 5 to 10 years. And as equity markets go up, the temptation is people get more confident. They say, the UK economy is doing well, the American economy is doing well, we can take more risk. The lesson of history in investing is, as the market goes up, you want to take less risk. And you systematically want to move out of more cyclical stocks, more economically sensitive stocks, just because there's not that much road. Now, we think the American recovery's still got a long way to go. We've only started to move towards more stable companies, but you have to do it as a matter of discipline as the cycle goes along. You wait for people to get overexcited about how fast the growth could be, and then you take profits when valuations get too high. And at the end of the day, even though European economies are now predicted to grow at all this year, which people regard as terribly exciting, we're going to have positive GDP growth. Positive GDP growth is not the same as growing so fast that you're catching up with the increased social costs of looking after the aging population. It's not enough just to have 0.7%, 0.5% positive GDP growth.
You mentioned UK equities just a moment back. Your fund seems to have a very low weighting of UK equities. Why?
Well, we had quite a lot, and they went up a lot through to this spring. In fact, the UK equity market peaked in the spring. It's not actually done very much over the summer, despite the economic news being really very healthy and better than we might have expected. So we've actually found some stocks coming back to levels that we're quite comfortable about recently.
Okay.
In fact, just this week we bought some Land Securities because the very large amounts of dollars out there which have been printed over the last few years are still looking for a home. They didn't find much of a home in US Treasury bonds. They haven't found much of a home in emerging market debt, which has just been clobbered by the currencies. So we think things like London property, central London office property, is just the sort of asset that people might come back to.
Okay. Despite this whole thing about, I have heard some people slightly pessimistic about the long-term future of the city as far as a global financial center.
Yes, I'm puzzled by this. I mean, I've heard this over my career many, many times. I've heard people expect Frankfurt, Paris, and various other financial centres to pick up. The world's financial centres seem to be, New York and London, and somewhere in Asia yet to be decided. People thought it was going to be Tokyo. When I was starting off, people thought it was going to be Sydney. So that moves around.
Right. Okay.
But no, for me, London has that critical mass of skills and talents and international range of top quality employees. I don't see anyone catching up. I think it's
human capital.
It's a world city, and I'd like to own real estate here.
Okay, so that's that. Also very important for investors now, tapering. Will it be or not?
Well, I think that once you've got a message out that you're going to stop unusual and unprecedented style of monetary policy, you may as well just get on with it.
Okay.
I also think that just stopping buying long bonds is not a dramatic decision in terms of American monetary policy. We will eventually have to get through to interest rates going up. I mean, if inflation comes back, at the moment inflation's very, very low, particularly in America, extremely low. But again, going back to your question about the UK's got to do some tapering at some point. We're actually rather closer to that level of unemployment coming down than some people might have expected. Unemployment here has been much more modest than it's been in America.
Yes, indeed it has.
On the other hand, inflation's rather high. So you've got American 10-year Treasury bond yields of 2.8%, but very little inflation. So you've got real interest rates there, so tapering is okay. Here you've got long bond, 10-year bond interest rates the same as inflation.
Indeed.
So savers here still can't get a real return without taking risk.
So
and that again is why people end up buying equities and something. But they don't want to take very much risk, and I'm trying to take as little risk as possible. That's things like Land Securities, great big chunk of real estate in the middle of London with a yield of, I think, 3.5%, trades 10% discount to its assets. That's the sort of thing that risk-averse people coming out of bonds would prefer to buy, rather than chancing too much of their arm on recovery hopes.
A relatively certain, in the case of Land Securities, for example, a relatively certain long-term macro trend and fundamentals value.
Exactly, that's the key. Don't expect huge returns, but avoid taking too much risk. I mean, that's our approach.
So a good risk-adjusted return.
Exactly.
Okay. Well, Simon Edelsten, unfortunately that's all the time that we have for today, but thank you very much for your time. We know you're a very busy man, and we hope you will join us again soon.
Thank you very much.
Thank you. And that's all for today from us here at Digital Look TV in London. Thank you as well very much for joining us again.